Alright traders, welcome back to my channel. Yesterday I made a video on this trade volatility 75. So if you go to my channel, go to the last video I posted, you see the video on Dominan Break. So I explained what Dominant Break means in that video, but I'm still going to talk about it in this video. So this is more like the continuation of yesterday's video. So as I was saying yesterday in the other video, I had a Dominant Break here. So in order to understand the continuation of the video, you have to first watch the other one. So we had this massive red candle, then we have series of smaller candles within it. That means this big red candle is bigger than the following candles. So as you can see now, we have this big red candle, and then we have this green one and the smaller red. So it mustn't be two, it can be like 3 or 4 or 5. But what you are basically looking out for is the one that will break out of this range. As you can see, this block that is here, this shadow. Hope you are seeing what I'm pointing at. This dark block that I used to mark out the zone. So finally we got a breakout on the third candle. That's this big candle. So but usually on the dominant break, what you are looking for is the candle that will break out and then move all the way to this level, 161.8. 161.8. That's the dominant break. So the candle that has to break out will break out and close above. So once the breakout has happened, you take your trade from there. Most times or sometimes the candle that breaks out doesn't really go this far before it closes. Sometimes once it breaks out some few pips, it will close, and then you take your trade from that place. Other times it will just move this way and then retraces back to the zone, tap into the zone before making this move to 161.8. So in this case now, that's what is happening. So after the green candle closed, we have a retracement to the zone again before going to 161.8. But it doesn't really happen this way every time. So but in order to confirm if you're going to take a trade immediately the thing closes, you might as well wait for second confirmation by going down to the smaller time frame. So if you watch the first video on this topic, on this setup, you understand what I mean by going down to the smaller time frame and looking out for a smaller another confirmation to add to this one. Now if you watch the first video, you understand exactly what is happening here. So we had the break, we had the breakout, and then a retracement to the zone. Now we are heading to 161.8, and that's basically what the dominant break means. I will still make another video on this, and hopefully that one will be a breakout and then continuation immediately without any retracement. Those are the two ways the thing can occur. But the dominant break itself is when you have in this scenario now, this is happening. We have a bearish candle here, a bearish candle, and then we are looking for a breakout to the upside, right? So in other case, it can also happen this way. When you have the massive green candle, a big one, then you have series of smaller candles. Then what you are basically looking out for is the one that will break out of the zone. So I hope you understand what is happening now. Those are the only two ways it can happen. When you have a massive candle, a green one, then having a series of smaller candles following it, then you are looking out for the one that will break out. But in this case now, we have a red candle, then this series of smaller ones that will break out. You're looking for a green one that will break out of the zone and then close. Then you take out your Fibonacci retracement. So just watch the first video, you understand how I plotted the Fibonacci retracement from the body to the wick, then waiting for the move to the upside. So eventually I'm waiting for this to get to 161.8, but on its way, if I notice or if I notice that it won't get to this place, then I'll have to break even or close my trade, because if you notice, this is the daily time frame. So yeah, that's it. Thank you for watching the video.